Today we are going to be talking about SoFi Technologies. We will go over a recent debt offering from the company, the sale of some shares from the Chief Technology Officer, as well as discuss the opportunity within the fintech industry over the next 6 years. And along with that, I want to compare and contrast some differences between Ally Bank and SoFi Technologies. So if you enjoy the video, drop a like down below, and if you want to see more videos like this one, make sure to subscribe. Year to date, SoFi's stock is down over 24%. However, over the course of the last year, it's up about 26%, but still down from its 52-week highs of around $11.45. From IPO till now, the stock is down about 30%, and from its all-time highs of $25, the stock is down over 70%. Keep in mind the environment that we were in back in 2020 and 2021. It is vastly different from where we are today. Back in 2020 and 2021, interest rates were basically zero, and people were flooding money into the market, especially into companies that were not profitable, which SoFi at that time was not. However, it did have a high amount of growth, and this interested a lot of investors. However, since then, we have seen interest rates come up in a major way, and this has not only affected valuations of stocks, but it has also affected SoFi's business model. However, over the course of the last couple of years, SoFi has done a very good job of diversifying away from being reliant on interest rates. They have gone from being a business that was mainly focused on student loans, personal loans, mortgages, to a company that is more focused on being diverse across a wide variety of products like checking accounts and savings accounts. One thing that all companies have suffered from over the course of the last couple of years has been the increasing of interest rates. What this does for companies is it increases the cost of their debt. And whether you're an Apple, an Amazon, a Google, a Microsoft, a SoFi, a JP Morgan, a Bank of America, an Ally, you have debt on your balance sheet. And what that means is that debt has become more expensive over the course of the last couple of years. And as the market starts to turn and we start seeing interest rates potentially dropping, a lot of these companies will look to refinance their debt. And SoFi is no different. They have issued around $750 million of convertible debt. And here is Anthony Noto, the CEO of SoFi, talking about why they made this move.
What we saw was an opportunity from that position of strength was to lower our cost of debt. We had two pieces of debt that were quite expensive. One we did in 2019. It is a Series 1 preferred that pays 12.5% interest.
That's so good.
5 years after we issue it, we can buy it back in May. If we don't buy it back in May, we'll have to not just pay 12.5% interest, but it actually goes up to 15% interest for the next 5 years, and we can't buy it.
Okay, so in other words, it wasn't like you could play around. If you tried to think that maybe it would go to 12 and we got to May, you would have, and it didn't go to 12, you could have been hurt. It was not like the risk was, hey, listen, it could go up to 20 here. It was the opposite, which is that you had to get this piece done.
Well, I would put it this way. We saw it as an opportunity to do it and have a negligible impact on GAAP earnings per share, and also combined with a buyback, have it be accretive.
But did you think the stock was going to get crushed like this?
Let me finish. Have it be accretive to tangible book value per share by 8 to 10%.
Okay.
When you do a convertible, there is pressure on the stock from investors shorting the stock against the convertible. Right. It's a delta hedge. That does happen. So there is typically 5 to 10% decline. But the reason why we did it is really important, because I think this is what will put some momentum back into the stock. First is we had this 12.5% debt. We also had another piece of debt that's about $500 million that we pay 7% on. So we're going to save between $40 and $60 million of interest expense a year by refinancing from 12.5% down to 1.25%, where the convert is, and from 7% down to 1.25%.
So that is a really good example of why SoFi issued this convertible debt. They were looking at their interest rates, these high interest rate loans that they had, and trying to find a way to refinance them as well as save the company some money. And they're expecting this to have an impact of $40 to $60 million per year. So generally, the market perceives debt issuance as a negative thing. So when SoFi issued this debt, we saw the stock drop. And again, Anthony Noto talked about the short interest that comes into a company when they issue debt. So that is one pressure that has driven the stock down slightly, but we also had some selling pressure from the CTO at the company. The Chief Technology Officer, Jeremy Rochelle, sold 56,000 shares of the company on March 19th of 2024. Personally, I don't pay a whole lot of attention to the buying and selling of shares from insiders. A lot of the times, these buys and sells could have nothing to do with the stock's performance. like this CTO could be selling shares just because he has a large tax bill that's coming up here in the next month or so. However, when we look at Anthony Noto, the CEO of SoFi, we can see that he has only bought shares of SoFi over the course of the last 2 years. And you get a really good idea of where he believes the company is undervalued by seeing when he starts loading up on shares. And it seems to be under that $5 mark. Here he bought shares for $4.67, and then he bought another large stake at $5.50, another large stake at $4.59, and a huge stake at $4.42. I saw this article today saying that the fintech industry is projected to reach $882 billion by 2030. That is equivalent to a 17% compound annual growth rate over the course of the next 6 years. And SoFi has a large amount of potential to capitalize on this growth as they are one of the fastest growing players in the market. When we look at Ally here in a second, their growth has slowed down significantly. However, SoFi is still growing their members and their revenue at very high rates. Currently, North America has the largest fintech market with a value of around $90 billion as of 2022. So there is still plenty of growth in this region. However, the Asia Pacific market is expected to grow the fastest through 2030, and this has to do with population growth as well as technology growth in that region. However, currently, SoFi does not have a presence in the Asia Pacific region. They are primarily focused on their US market. And one of their main competitors in the US is Ally Financial, which year to date is up a little over 11%, and over the course of the last year, they are up almost 64%. Ally Financial is a little bit more mature of a company than SoFi. They have a little less growth behind them. However, they are more established and a more profitable company overall. And we can see that analysts for 2024 are expecting Ally to bring in an EPS of $3.11. This is up slightly from a year prior when they brought in $3.05. And with the expected drop of interest rates over the course of either 2024 or 2025, analysts are expecting Ally to grow their EPS by 72% year over year to $5.37. On the other hand, SoFi is a lot younger of a company. They are focused more primarily on growth, growing their members, growing their revenue, and expanding the business. And we can see here that analysts have a projected positive EPS number for 2024 of 8 cents. And this is a large amount of growth year over year because in 2023, they brought in negative 36 cents per share. And just like Ally, with the potential dropping of interest rates, SoFi could capitalize on this in a major way. And analysts recognize that as they have around 212% growth year over year from 2024 to 2025, with them projected to bring in around 25 cents of EPS in 2025. With these EPS numbers being smaller than Ally's, it's easier for a company to show impressive 100%, 200% growth. The question more so is, can they continue this over time? And the answer is likely no. Those numbers will start to drop down into maybe 50% in 2026, maybe 40% in 2027, and start dropping lower and lower as the company becomes more established and more mature of a company. Jumping back to Ally, we can take a look at their top line, and analysts right now have around 0.6% growth year over year for Ally. This would bring their revenue up to around $8.27 billion, and in 2025, they're projecting that this revenue growth will accelerate to around 12.4% year over year. This would bring their total revenue up to around $9.29 billion. For SoFi, it's a lot more important for them to grow their revenue at a quicker pace. We can see that for 2024, analysts are projecting around 16% growth year over year. This is far better than what Ally is seeing of around 0.6% growth year over year. This would bring SoFi's total revenue to around $2.41 billion. And in 2025, this growth is expected to continue at about 17.1% growth year over year, and that would equate to around $2.82 billion of revenue. And because of some of these differences in growth, these two companies command different valuations. For Ally, they are currently valued at a forward P ratio of about a 12.47. SoFi, on the other hand, because of their larger amount of growth as well as them just reaching profitability, they have a current forward P ratio of about 104.17. One thing I want to point out for Ally and SoFi is their member growth, specifically their banking customer growth. And for Ally, we can see that in Q4 of 2022, they were sitting around 4 million Ally banking customers. When I scroll through Ally's Q4 2023 numbers, I can't find the same metric metrics that they showed in Q4 of 2022. And this for me is a little bit concerning because oftentimes when those metrics start going in the wrong direction, these companies will start pulling them from their earnings reports. And that is a little bit concerning. Here, the only number that I could find is that their current Ally Bank deposit customers is sitting at 3 million. And supposedly this is up 13% year over year, which may be accurate. That 4 million number from 2022 could just be their total bank customers. And this 3 million number could be the number of customers that have direct deposits set up. SoFi groups everyone together into a members number, which is sitting around 7.5 million members, which is up 44% year over year. And this is great for SoFi continuing to grow their members. The comparable number that I saw for Ally seems to be somewhere around 13 to 14 million members in total. So they are a little bit behind Ally in terms of the number of members that they have, but SoFi in terms of their growth, they're sitting around that 40% mark year over year. I expect that probably to continue to drop slightly, maybe into the 30% over the course of the next 1 to 2 years. Overall, I really like SoFi stock. I think that they're in a great position, and the refinancing of this debt, I think overall in the long term is going to be a positive thing. And this downturn that we've kind of seen at the start of the year could actually be a decent buying opportunity as it opens up the door to a lower price before SoFi starts reporting on some of these numbers. As we see this refinance go through, we have that $40 to $60 million net gain that they're going to get from this over the course of the next couple of years, on top of the growth that they're expected to experience over the course of, again, the next couple of years with interest rates dropping. So overall, I think SoFi is well positioned in the market and could see a lot of growth. I think SoFi has more risk. If you don't like the risk and you want a more stable company, I do think that Ally is also a good option. But keep in mind, do not buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. So I hope you enjoyed the video. If you did, drop a like down below. And if you want to see more videos like this one, make sure to subscribe. And as always, guys, have a wonderful rest of your day. We're going to leave off the video with a good dad joke. Why are nudists bad for the stock market? Check the comment section down below for the answer.